let's talk about some of the advantages of day trading. Because you're going to be trading actively and generating a lot of commissions, brokers tend to, though not always, reduce commissions on day trades. So you'd be paying less on a day trade than you would on a position you hold overnight. The leverage can be enhanced in day trading simply because the margin requirements are often less because the risk is less to the clearing firm. So they let you take more positions for the same amount of money on a day trade basis than they would if you go overnight. You know, the market, every position is marked to the market every day at the close. As a day trader, you would not have a position, and therefore you don't not have to worry about margin calls. And the third reason, fresh start every day, is very important because there's nothing worse than getting into a commodity, getting paper losses, and then worrying about it. You come in the next day with a frame of mind which is not suitable to making money. As a day trader, every day and every day at the close you have a judgment made, and it's either you're a winner, you're a loser, and you're out of the market. When you come in the next day, you're fresh. You do not have a point of view already established and ready to get going. I can't tell you how many times I've gotten letters or people have called me up saying, what do I do now? I sold the S&P and I've had incredible losses and it's getting worse. And I say, well, why didn't you get out? Well, I didn't want to lose the money. I thought it would come back. It's just not a good way to trade. That's what I call a stupid mistake versus an intelligent mistake, which you'll continue to make throughout your trading career. So day trading gives you a fresh perspective on the market every day, and I think you need that to win. It also provides you with the ability to capture many moves and take the best trades. Now, nobody says that on any given day you have to trade or you have to take this trade or that trade. As a day trader, you wait until everything is ready to operate in your favor. You pick the trade you want and then you go after it. Now, it may not be a winner or it may be a winner. The point is you make the decision, and you're not under pressure to ever take a trade, and you're not under pressure to do anything which may not help your trading account. I might add that you should have a rule as a day trader not to take any positions overnight. When I started as a day trader in the gold market, occasionally if I had a winning trade, I'd say, well, this is great, why don't I take it overnight and it'll get better. Well, the problem is the next day I'd be up at 5 o'clock in the morning listening to the London Open to see how our gold market would open, and chances are a lot of times it didn't open better, it got worse. On the other hand, I had another rule, no losses overnight ever. If you take a loss overnight, you're asking for trouble. Usually it gets worse, not better. So as a day trader, you have to have that discipline to stay with this method of trading. Now, getting started. You try to capture a short-term move. And I mentioned this earlier, how you do not want to be a scalper. What you want is to catch a move during the day, to buy if you think it's going higher, then to sell out at a profit and leave with the money in your account. Or, on the other hand, if you think it's going lower, you sell it short, wait for a break, cover, and leave. The best trades are the ones where you buy or sell it at the open or shortly after the open, depending on what method of trading you're using. You get a move in your favor, you close out the position, and you leave. You do not go back that day. You now have a profit, you take it home with you. It's not always easy, and you can't always do that. However, that's the ideal situation. I've mentioned this before. Once the day is over, you are flat. You have no position in your account. You won't have a margin call, and you have either won or lost, and then it's over with, and you move on to the next trading day. This is elementary, but if you're a novice trader, you have to sell what you first buy, and if you sell short, which means you sell first, you have to buy that back later in the day. One offsets the other, and you'll have no position after that. You won't be correct every time. Remember, as a day trader, you're going to be making many, many, many trades. You have to accept that, as a rule, half of these trades are going to be losers. But even if you lose half the time, you can still make money. You can lose, for that matter, 3/4 of the time on trades and still make money. And of course, the key is the old adage of letting your profits ride and cutting your losses short. I've mentioned this, no overnight positions, and this involves discipline. If you decide to be a day trader, be a day trader. Don't make up the rules of the game after you get into it. Know what you want to do in advance, and then trade according to that plan. I can't stress enough the importance of discipline. It's very important. This next point, concentrate on one market. There seems to be an inverse proportion between how new someone is to trading and how many positions and how many commodities they take. The professional floor traders would never think of trading more than one commodity at a time. If a person is a bean trader, he's a bean trader. If he's a cattle trader, he's a cattle trader. If he's an S&P trader, he's an S&P trader. He doesn't wake up in the morning and say, well, I think I'll take a position in the yen today, even though I've never traded it before. The reason is that markets have certain characteristics, and you have to get to know them. You have to know what a certain kind of a break means. Is it a real break? Is it just a meaningless random move? And as a new trader in a new commodity, you're not going to know that. So it's important to concentrate and learn all you can on one commodity. Now, if you want to take more positions, fine. That's okay if you have more money. Take larger positions. But I still think that you should concentrate on learning all you can about one commodity, and then from there move on and trade something else. There's an old story, perhaps apocryphal, about a corn trader walking off the floor, and a friend of his comes up and says, well, what's wrong? And the corn trader says, well, I'm broke, I'm busted out. And the other trader says to him, well, why don't you come over and trade beans with me? And the corn trader says, but I don't know anything about beans. And that kind of illustrates the thinking. I mean, presumably if he knew something about corn, he wouldn't have gone broke either. But traders on the floor do concentrate on one market, and I think that's good advice for people off the floor as well. Okay. You want to learn all you can about the basics of your market. And this is elementary. It's something that everybody must know. And you have to know the value of a tick. If you're an S&P trader, you know that every tick is $25. If you're a bond trader, you know that every tick is $31.25. If you're a grain trader, you know that a penny is worth $50 a contract. You need to know the trading hours. And this is important because the two most important times of the day are the open and the close. A lot happens on the open and the close, and the more you learn about your market, the more you'll know how to read the opening and the close. And this can give you a clue into how to trade it that day. The margin, of course, will vary from house to house. And, of course, margin is a function of volatility. If you're going to trade S&Ps, you're going to be paying a lot more in margin than if you trade a slow commodity like corn or oats, though they're not good day trading vehicles. You want to know the value of a contract. In the S&P, for example, at 300, it's 500 times as much, so it's a $150,000 contract at that price. Now let's go over on the summary here just some of the things we've mentioned in the early going here of this video. First and foremost, never scalp. A lot of novice traders think that it's very easy to buy at one price and sell at a different price and make a quick profit. When you factor in the cost of the commissions, when you factor in what is known as the edge, in other words, you're buying at the offer, you're selling at the bid, you're giving up another tick, it really adds up, and it does not pay for you to try to buy the bid and sell the offer, or to buy the bonds at 14 and sell them at 15. Because believe me, there'll be days when you buy them at 14 and you'll have to sell them at the lower 9. And it just won't work out over time. You want to look for 1 to 3 trades a day. My rule is you try to make a profit every day. There will be days when you can't do it. If you can make the profit in the early going on the first trade, fine, take it and leave. If for some reason you have a loss, you can double up. You can double up in reverse. You can reinstate the first trade if you feel that you were correct in the initial trade but you got out at a loss. But once you get beyond 3 trades and they're all losses, then you're getting into trouble because you're chasing your losses, you're not thinking as clearly, and every trader, no matter how good, will have days when just everything goes bad. And you do not want to have a day like that, because what will happen is you'll lose in a day what it took you months to make if you keep increasing the number of contracts. So set that limit, do the best you can on the first trades, and if it doesn't work, forget about it and come back the next day. Remember, the most important thing is survival. Just try to survive at first, and the profits will come later. I've covered this. Don't push a losing streak. It may not get better. This happens to every trader, no matter how good. If you're aggressive about the market, you'll just find yourself on those days when nothing works. Fortunately, you don't get those markets that often, but you will get them from time to time, and we're going to discuss those type of markets in a minute. It's what I call the search and destroy days. Have sufficient trading capital to start. Remember, you go into this with a certain amount of capital that you can afford to lose. It's risk capital. You're not betting with the rent money in the market. It's not a good way to win. In fact, I don't think you can win at all that way. So no matter what happens on any given day, you walk away from the market saying, I did my best, and I either had a winning day or a losing day, but everything's okay because it's a process, and I'm working myself through this process, and it will work out in the end. Know what you're willing to lose. You need to determine this in advance, not after you get into a trade or a series of losing trades where you say, well, now I've lost so much money I can't quit, I've got to get it back. That's the wrong way to think. Remember, you want to make intelligent mistakes, not stupid mistakes. Don't think about the money. Now, this is very hard. It requires discipline. But there will be times when you'll have to do things in the market that require courage to do them. I can think of days where it was necessary to double up and reverse. When you've already lost once, it's hard to do that. Now you're risking twice as much, but it's a necessary thing to do, and if it's part of your game plan, you have to be able to do it without stopping to think, uh-oh, what will happen now if this trade turns into a loser. My philosophy is you put in more money than you need in margin. You don't put in the minimum. You put in more than you need, and then you trade at a level at which you're comfortable. I find that if you're comfortable at 1 lots, you can do 1s and 2s if you reverse, and perhaps up to 4. If you're comfortable at a higher level, fine. That depends on what your own financial situation is. Again, the next point, trading is a process. Losing trades are part of that process. You can add up at the end of the month the number of winners and losers. If it's about 50-50, I think you're doing something okay. Of course, the profits should exceed the losses, but just on average, you should lose about half of your trades. The key is to keep the losses very small, of course. Emotionally, a winning day is the same as a losing day. You do not want to think, well, I can't go out tonight because I lost so much money today. You have to trade within limits, and no matter what happens today, you come back tomorrow. This is why so many traders have to leave the markets. They're forced out for financial reasons. It's better if you don't have the trading capital initially to somehow get it, put the capital in the account, and trade within your limits.